This was the screen we were discussing in the previous session, methods of payment. And now we can just see them one by one. So first is cash. So we say cash payments, for example. So payments by cash, we say cash payments are used for the following. Usually, I tell you, in most businesses, and actually, by the way, governments also do not allow a lot of cash payments, and businesses also do not want to make or receive a lot of payments in cash, because cash payments, they have higher risks of fraud or mistakes. So we only make cash payment when it is very important or when it is necessary, and usually cash payments we make for small amounts. So cash payments are used for the following: small payments we make, sometimes for wages, not for salaries. By the way, there is a difference between wages and salaries. I should explain you now at this stage. Both of them you pay to your workers, but salaries, salaries are fixed amounts. These are fixed amounts, and these are paid one time at the end of the month. Wages are not fixed. Wages you pay on daily basis. You calculate the amount of work done, and then based on that you pay wages. So remember that, for example, if you work in a bank and you get your salary after, I mean, you get your salary every month. It's a fixed amount, $1,000 you receive. You work more, you work less, you get $1,000 fixed amount end of the month one time. That is called salary. But if you hire someone, to do some labor work for 3 days, 4 days, 5 days, 2 days, you will see how much work they have done. Accordingly, you will pay them. That is called wages. So salaries and wages are two different things. So sometimes wages we give in cash. It is like I said, that cash payments we only make when it is very necessary, and it has to be small payment. These are wages. Using cash to pay large amounts of money to suppliers ought to be very rare indeed. Ought to be very rare, which means that it is very rare. It's very rare. We don't pay large amounts of money. You can't imagine you have to pay someone $30,000, $100,000, $300,000, and you are taking bags of cash. It does not make sense. So cash needs to be kept secure. Cash can get lost in the post, of course. It will be difficult to keep control over cash. You need to, put under lock and key. You need to count, and a lot of things are there. Unless a supplier issues a receipt, there will be no evidence that a cash payment has been made. So when you make someone a cash payment, always take a receipt that they have received cash. This is the evidence. So tomorrow, if they say that I never received the payment, you show them that piece of paper, that receipt, that I gave you the cash and you gave me the receipt. So if you don't have the receipt, then you cannot prove it, because you gave someone in hand. They can say we didn't get it. So this is the problem with cash. In bank, it does not happen, because when you transfer to someone through bank, it goes from your bank to their bank. So bank statement has the evidence. Even after 10 years time, you can take a bank statement and show them that, 10 years ago on this date from my account, this much money went to your account. So proof is there, evidence is there. In case of cash, this kind of evidence is not available. The only evidence you have is the receipt. So make sure that you receive the receipt, and then you keep the receipt, you do not lose it. So not surprisingly, the use of cash to make large payments to supplier is sometimes associated with shady or dishonest dealers in the back street. Yeah, I mean, if you imagine someone is giving someone $1 million in cash, it looks like that, there is a perception. There is a perception, and that perception is quite true. Why do you want to deal in cash? Because you want to hide it from the tax department, you want to hide it from the government. That's why you take and receive cash in the dark. Because when you pay someone through the bank, or you receive money through the bank, it comes in the accounting, it comes into the banking system. The tax department can see, the government can see it, other regulators can see it. It's open, it's transparent. But giving cash to someone actually creates a signal or a sign that something wrong is happening. Why you are dealing in cash? Payments by check, this was our second type of payment. That is a secure way of payment where you write check in someone's name. So the most common method, and this is actually the most common method of payment by business, excluding wages and salaries, because wages we do not give by check. Wages we do by automated bank transfer. I explained you before in the previous session. Wages, because we have got 3,000 employees, so we cannot give 3,000 checks every month to every single employee. We cannot. So wages and salaries we don't pay through checks, but other suppliers mostly we pay through check. Checks are for payment out of a current account at a bank. So you have two types of accounts in a bank. Businesses mostly have current account, but they can also have a savings account. So remember that two types of bank accounts are there most commonly. One is called current account and one is called saving account. Or you call them FTCs, fixed term accounts, okay? So savings account, you do not touch. You put your money there, it remains there for a longer period of time. So the everyday money which you receive and which you receive and pay money in your current account. So business has got a current account, and the current account is for the purpose of receiving money maybe 10 times a day, maybe paying money 100 times a day. So current account is very active. But you cannot do this thing with savings account. You cannot, the banks will not allow you. You cannot go and take out money every day from saving account and then put it back. It does not happen. So we do it with the current account. You will be provided with checkbooks, like, checkbooks, and they have 50 leaves, 100 leaves, 200 leaves, etc. And then you can write down the check and give it to anyone who needs it. And the checkbook need to be, every check you have to put signature and you need to put a stamp, and you put the checkbook in a locker, in a locked drawer, so that it is safe, so that the checks are not stolen. This is actually one way of doing fraud or something wrong in the business, that somebody steals your checkbook. So that you should make sure that your checkbook is under, how to say, strict control. So signature on business checks, of course, you need to put signatures. A bank will not permit a payment by a check from customer's account unless it has been properly signed. And not only signed, but it is also stamped. So two things are there: sign and stamp. And only the authorized people can sign the checkbook, because if you appoint Mr. X, if your company appoint that Mr. X can sign the check, then the Mr. X should go to the bank and give his signatures, a sample of his signature, so that the bank can keep this signature sample in the system. So every time a check will come, the bank will see if the signatures on the check, they match with the signatures in their system. It's not like I, you, me, everybody will sign. So there are people who are authorized to sign, usually 2 or 3 in a company, who can put signatures. And of course, then a stamp is also needed. Company stamp, we call it. Okay, you understand, round type of stamp is here. Your company name is written, something like this. So signatures and stamped signs should be there, and signatures of the authorized people. And these authorized people, their signature record is kept by the bank as well, so that the bank can match it. So advantages and disadvantages of using checks. Actually, there are more advantages. Advantages are, checks are convenient to use because you can open up your drawer if you are authorized person, write down a check, put a stamp and give it to someone. So that's a convenient process. The check counterfoil and check number can be used to provide a useful method for tracing past payments. So what happens, counterfoil, when you see the check like this, so the check has two parts, okay? This is like here, this is a perforated line. So you write down here the details, the name of the person, the amount, etc., date, and then you put this information here also. So this piece you will tear away, you will tear it apart, and you give it to someone. But this counterfoil, it remains with you. So that it is called counterfoil. So in the future, if you want to see that whom I issued the checks, you can just see these small pieces. So it is actually one check which has half part you have given to them and half part you have kept with yourself. So then you can trace the past payments. Okay, these are the two advantages. Let me see if there are any more advantages as well. First, I will explain advantages, then I'll come back to this. Okay, so there is nothing else. Then you say that the disadvantage, there are security problems with keeping checks safe from theft and misuse. Theft is possible, misuse is also possible. Like forged signatures, somebody will copy your signatures, they will steal the checkbook, they will copy your signatures, and they can take out money. This is one of the disadvantages. And the second is checks can be a slow method of payment. Slow method of payment in the sense that you have to come to me, or maybe I have to send a check by post to you. Then you will take that check to your bank and ask for the clearing, and the clearing process will take 2 or 3 days. So let's suppose I promise today that I'm making you payment today. Okay, and I say, okay, I'm sending you the check. So I will write down a check. I say, can you come and collect? You say, no, I cannot come. Please send it by courier. I say, okay, so now it is 5 o'clock or 4 o'clock. The courier will come tomorrow morning. And tomorrow morning, I will give him the check. And one day later, he will deliver it to your office. So 2 days have passed. When you get this check in your hand, now it's already 2 days past. And then you need to take this check to the bank, deposit it in your bank, and then your bank will collect money from my bank and put it in your account, which is called clearing. We discussed it before as well. And the clearing itself will take 2 days. So you actually get money in 5 days' time. I said it today, I'm paying you. And actually, when you receive, it's 4 or 5 days have gone. And in business, it's a big time. You have been waiting for your money for 3, 4, 5 days. So checks are a slow process. Direct debits are faster. Direct debit, we don't have check. So I go onto my system and I go to my online banking and I transfer money to your account now. And it will be in your account in within 10 minutes. If it is a working day, and if we are in the same country, if we are in the same country, and if it's a working day, if I make a direct debit from my account, the money will be in your account in 10 minutes. In 10 minutes, nothing else. So direct debits are actually much faster than checks. And by the way, this check system, I must tell you now, I've been explaining you a lot on this check, but literally these checks are not really very much in use now. In most modern economies and the countries where banking systems have updated, they are not using checks anymore. They are using actually direct debits. Checks are there. You have a right to use, but normally it is not used. We use mostly direct debits. Payments by banker's draft, we call it payable order. A supplier might sometimes ask a customer to pay by bank's draft. Now, if you remember, I told you this thing before as well in banking as well. We call it banker's draft or we call it banker's check. See, when you have this check, for example, if I'm giving you this check and I write down here $10,000 and I write your name, A company, I put it in Word $10,000. I put my signatures and I put my stamp and I put the date and I give you this check. This check I have written here. There is no guarantee that the money is in the bank. Maybe in my bank, there is only $1,000. So when you take this check to my bank, the bank will say, sorry, we cannot make you payment because the account does not have sufficient funds. It has insufficient funds because the bank did not know that what I'm writing, if I want, I can write down here 10 million. I can put 10 million on my check and put signatures, but that does not mean that the bank will give you 10 million. Bank will only give you the money which I have in my bank, which might be only $1,000. So it means that in case of checks, it is possible that frauds may happen because I buy something from you for $10,000 and I say that, okay, give me this. Okay, let's suppose you are selling your car to me and I bought your car for 10,000 and I give you a check. You transferred the car in my name. But when you take the check to the bank will say there is no money. But you already have transferred or the car in my name. You are actually now in problem. So for in certain cases, when there are customers who do not know each other very well, or when there are some large amounts are involved, many times the customers, the suppliers, they may ask to a bank draft. They say, oh, I don't want check because I don't know, you will give me the check, but I'm not sure if you have money in the bank or not. I'm not sure if the bank will give me this money or not. So either you give me cash, I say, no, I cannot give cash. So then he say, okay, give me banker draft. So banker draft is called a banker's check, and it is 100% safe. It is 100% safe. Why it is 100% safe? Because if I said, can I give you $10,000 check? You said, no, 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 don't give me $10,000 check. Give me a banker's draft. So when you ask me banker's draft, what I need to do, I need to take $10,000 with me. I go to the bank, I put money to the bank, I give this money to the bank, $10,000, and the banker will give its own check, not my check, but the check issued by the bank. And the banker check, when it is issued, it means that 100% cash is at the bank. So bank received 10,000, put it here on one side and say, who is going to come and receive? I say, please make a check in Mr. A's name. So the bank will make the check on its own checkbook for Mr. A, which says 10,000. And it means that A can go to the bank and collect 10,000 anytime he wants. Now, when I take this thing, the banker's check, and I give it to you, so you are relaxed. You know that, oh, the money is already in the bank and the bank has given the check. And the bank is saying, come and take money from me. So banker's check is more secure form of payment. Payments by standing order and direct debits. So direct debits means that I instruct my bank to transfer money from my account to your account. This is called direct debit. Very straightforward transaction. Standing order, I explained to you before. I tell you again now that standing order is where you give instruction. It is also sometimes called standing instructions. Standing instructions or standing order. So if you have to make some fixed amount, if you have to make a payment of fixed amount on a fixed date to someone every month, let's suppose I need to pay my rent, $1,000. Let's suppose that I need to pay my internet, $100. Let's suppose I need to pay my kids' school, $500. So on the first of every month, I need to make these payments. So what happens, on the first, I go take out 1,000, I go and pay my rent, then I take out 100, I go and pay internet, then I take out 500, I go and pay to the school. That wastes a lot of my time. What I can do, I can write a letter to my bank, and I will say that, I will address to the bank manager, and I will say that on the first of every month or on the fifth of every month, please debit my account with $1,000 and credit that account, which means that take money from my account and put it into that account. So of my 1,000 rent, so I give my landlord's account. Then I say on the fifth of every month, take out $100 from my account and give it to that internet company, 500 from my account and give it to the school. So what is happening? I do not need to go to the bank every month now. On the fixed date, the bank will take out the fixed amount and send it automatically to that account where I told them. And this thing will continue to happen every month. It will happen every month. And that makes my life very easy. Bank will keep on doing it because they have mentioned it or they have written it in their computer system and it becomes automated. They will keep on repeating this transaction until I send them a stop instruction. So if, for example, my kids are no more in this school, I will send them a stop instruction that from next month, please do not send this 500 there. Or maybe if I've changed my office, I will close this one as well. And I will send them a stop instruction that from next month, please do not send this 1,000 to that account. Stop it. This is called standing order, or sometimes we call it standing instructions. It is an automated process, just. Standing orders, they have explaining you now. I already have explained you, okay? So you can see these examples. I already have explained to you, you can read it from here, but I already, it's about for regular payments, fixed amounts, etc. Direct debits from one account to another account. It's very simple. I go online, I can do it online, or I can fill in a form. Banks, they have that form. I send that form to my bank. Instead of giving a check to my customer, I send the form to the bank. So if you are doing physical banking, you will fill in the form, that which means that which is the receiving bank, which is the paying bank, which is the receiving account number and title, what is the paying account number and title, and how much is the amount. So I will mention my name, my bank account number, the amount, and then I will mention whom this money should go to, their bank name, their account number, their account title, and I write down the amount and I put a stamp and I send this piece of paper to the bank. That's all. And the bank will automatically do it. It is called direct debit. And usually for your suppliers, regular routine business suppliers, we call them trade suppliers. Mostly we use direct debits. Documentation to go out with payments. Documentation to go out with payments. A business should send proper explanatory documentation with all payments to avoid confusion. For example, if I say that if I put one statement that paid rent, let's suppose $1,000. So you don't understand that this month, this rent is for against which invoice, or this rent is for which month. So there is a confusion, right? This statement is not clear. Similarly, when I put document, we should have some explanatory documentation to avoid confusion, so that 6 months from now, or maybe 2 years later, if you want to track some transactions and you want to see that, whom I paid, why did I pay, you will not understand if you see this statement after 2 years, paid rent $1,000. It means nothing. It means nothing. It does not tell whom did you pay, which month was the rent, which invoice did you pay. Nothing. It just says paid $1,000. That's all. Similarly, when you put documents, your document should be explanatory. Copies of the relevant documents, which mean invoice, you can put in, so that it becomes easy to understand or track back that why we made payment, to whom we made payment, for what we made payment. So far we have concentrated. So this is actually a revision. So that's all. Actually, this chapter is finished. Now we move to next chapter, which is chapter number 9.